everybody. Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Saturday, January 24th, 2026. Hope you're all having a great week out there. I know everybody on the Northeast is bracing for the big snowstorm that is supposedly coming our way later tonight or sometime into Sunday, Winter Storm Fern. So hopefully everybody out there stays warm and safe and makes it through the storm without any incidents. We are back again to update you on the markets and the economy. A lot of different things going on in the markets this week as the World Economic Forum held their annual meeting in Davos, Switzerland. You have a lot of heads of state there. Obviously, the U.S. administration is there, many global business leaders, many of CEOs and the likes from U.S. companies. So it's a really good time to take stock on the global economic order and to see how things are being presented and what's playing out and what deals are being made. It always creates volatility, those types of events, when you have not only the president from the United States, but presidents and leaders from other countries, making speeches on the world stage. So naturally, that's attention grabbing and markets react to that. We did have some news out of Davos this week, which was very constructive. But before we get to that, first, let's rewind ourselves back for a moment to last Saturday, okay, where Trump announced, right, that obviously we know the U.S. wants Greenland. They want it for national security purposes. They want to make sure that the Arctic doesn't fall into the hands of the Russians and the Chinese. And so about a week ago on Saturday, right, we had Trump tell the world via Truth Social that if the U.S. doesn't get what they want in terms of Denmark relinquishing control of Greenland to the U.S., that the U.S. was going to impose new tariffs on the European Union and all goods that come from there. So, you have to know a couple things about Trump, right? This is not the first rodeo with Trump, guys. We had him for a full term already back from 16 to 20. And here we are again in the second go around. And, people overreact to everything he says. And Trump has a knack for dropping this type of news over the weekend when the markets are closed. And I don't think it's coincidental, okay? And I think he does this to gauge reaction, to give the markets a couple days, right, to react. And remember, last weekend was a 3-day weekend with the market holiday on Monday for the Martin Luther King holiday. So naturally, markets couldn't react to this until Tuesday morning. Now, we saw a down open on the market on Tuesday, right? The natural built-up fear, kind of that pent-up energy from the weekend. Everybody's ready to react and people sell. And, I can't say this enough times, right? Aside from the fact that Trump's unpredictability, is a feature, not a bug of how he operates. I mean, folks, let's remember, the guy literally wrote a book, 15, 20 years ago called The Art of the Deal, where he told you exactly how he negotiates. He asks for way more than he wants and then settles somewhere in the middle and gets close to what he wants. This is literally in print. And yet every time Trump does this, the media freaks out, everybody freaks out, okay? The markets tend to freak out before finding some normalcy. So he drops this news right before Davos, and what do we think was going to come out of that meeting? Trump announces, right, on Wednesday, he's reached the framework of a deal with NATO and relinquishes the threat of European tariffs. So the market goes down on Tuesday and then shoots right back up on Wednesday, okay, to the surprise of everyone. And I want to invite you to think back just over the last couple months how the threat of tariffs has been used as a tool, right? They levy this concept. They say, we're not putting them on today. We're going to put them on in 2 weeks. And then some point over the next 2 weeks, they strike a deal. They get 80% of what they want. And then they walk the tariffs back and the market goes back up. And yet many market participants keep falling for this time and time and time again. So let's remind ourselves, the next time that you see Trump announce something and you're worried about this upsetting the whole global economic order, that there's a method to the madness. Whether you like it or not, he has always negotiated this way. So this is why we don't have knee-jerk reactions on, every little thing that he says and does, right? Now, so we see the news there. reached a framework for a deal. Obviously, the framework for a deal is not a deal itself, but it appears to be heading in the right direction. So we'll keep an eye on those developments there. Let's take a look at the markets together. Now, you can see here, zoom in a little bit. Okay, markets are just emerging out of what we called the fake out zone, right? Just to recap, if you haven't seen every one of our last couple videos, we expected there to be some volatile nature to start 2026 because that is what will convince many investors that this year is doomed to be a failure, right? Last year was good, even though nobody expected it after the April tariff terror. And now we start this year, and volatility is the type of thing that makes people uneasy. And so that's what we saw. You can see markets sold down on the initial threat of tariffs on Europe and then popped right back up when he announced that we're not going to do that, right? We're going to get what we want. And so markets now are starting to emerge from the fake out zone. And I think we are getting very close to the point of acceleration higher in the markets. This coincides very well with the fact that we are now staring in the face this week coming and the week after that of major corporate earnings from many market participants. We've already started in terms of reporting. The banks have already reported and the likes. But everybody wants to know how the tech companies are going to do, right? The Mag 7. How are they going to do? And I would say that the bar is set pretty low for these companies right now, right? Because there's that natural fear and paranoia that these companies just cannot continue to make the money that they're making. We will take the other side of that bet. We think earnings are going to come in fantastic. That does not mean that every stock that reports is going to shoot straight higher by 10 or 15 or 20%. You know how these earnings reactions can be. A company can have good numbers and sometimes it sells off. Sometimes they have not great numbers and the stock goes up, right? But I think on the margins, in mass, the aggregate of the group will report higher and will go higher. And that will start to move the markets higher. Now, there is another thing that's going on within the markets. Many of you are probably aware of it if you watch the financial news. And it's certainly, if you will, taking some of the shine away from stocks or taking the limelight away from stocks. And that is the move in commodities, okay? When you hear commodities, people immediately think oil. But we're talking raw commodities, gold, silver, copper, right? This is a chart of gold, okay? Going parabolic. This is a chart of silver, okay? Going parabolic, right? Silver's up, I think from basically it's more than 2x itself basically since November, okay? It's a very short period of time. Now, why am I showing this to you, okay? Aside from the fact that we've always had some commodities exposure because we think it's a good hedge, we are showing this to you because the commodities market is tremendous, okay? It is absolutely tremendous. And to get gold and silver to move like this, it takes a lot of liquidity, dollars that people spend in the market, away from other things, right? So to have a huge asset like gold and silver and copper going parabolic to the sky means that for whatever the reasons, whether it's fear, whether it's uncertainty, people are plowing money into these commodities. Now, you look at a chart like this, personally, I think you'd be crazy to be buying it up here, right? The time to buy it was a few months ago, not now. But that is not how the investing public thinks, and that is not what the herd mentality causes people to do. So at some point, commodities will start to reverse. Whether they come straight back down, like this, I don't think so. But even if they start to do this and just consolidate, that will be the spark that sets off capital flowing back to stocks, right? And so right now, commodities are sucking up all the air in the room, and this is why stocks like Apple and Nvidia and Microsoft and many others appear that they've just been treading water here for a number of months. Remember, we are in the midst of the largest, greatest technological revolution the world has ever seen, and yet nobody's excited about it. Okay, and that is a good thing for us. So we're going to keep an eye on this. At some point, you're going to see commodities start to reverse, and that will coincide with the S&P. That will coincide with the S&P and the NASDAQ and all the other indexes starting to take off to the upside. I believe we are close to that point. Earnings could perhaps, be the linchpin that swings things back the other way. But remember, it is not a bad thing that the markets have consolidated in a level here for a number of months, especially given all the money that has flowed away from stocks and into commodities. So again, don't expect the commodities trade to crash, but I think that right now it's hogging the spotlight and stocks will not be ignored for too much longer. Also, another thing I just want to mention, right? Everybody now is a gold bug. Everybody's interested in commodities. Why is gold moving like this? Well, aside from a lot of different concerns around hedging and the global order of things, let's remind ourselves that gold basically peaked in 1981 and has gone nowhere for 45 years, okay? And it's just recently broke above those 1981 prices, okay? So this has been a dead asset, folks, for almost 4 decades, right? And so when something lies dormant that long and it finally breaks out, when we use the term breakout, we mean breaks higher to new all-time high prices, these trends can go on for a little bit, right? Because there's so much pent-up energy in this 4-decade base, okay? So again, this won't last forever. At some point, commodities will cool off, stocks will come back into the limelight, money will start to flow back to stocks, right? And if investors were smart, like all of you are that are watching this, we would be deploying money into stocks here and now. But most people, right, they wait until price is running away from them, and then they will decide it's a good time to get back into stocks. Another thing we wanted to share, some data, is if you watch a lot of financial news media, all you will hear them talk about is how consumers are saddled with debt, right? The lower income, middle income, everybody's saddled with debt, and this big debt bomb is going to come and it's going to kill the markets and kill economic growth. And if somebody would just look at the data, they would realize that that is not true, and that's what you have us for. We are here to cut through the noise. This is the aggregate household balance sheet of Americans. You could see at a few different points in history. 1999, before the tech blow up of 2000, 2007, right, before the blow up and the great financial crisis that came thereafter, 2019, shortly before COVID, and again, back in Q3, the most recent data for 2025. If you look, folks are asset rich and debt light, okay? Liabilities are not in a concerning place right now. We're nowhere near the 2007, right, with all the problems that came from that. And we are holding very consistently since really 2019. We're actually in slightly better shape. You can see liabilities have shrank and assets have grown. And this fits along with one of the charts we showed you last week that shows that home equity, right, homeowners have the highest level of equity that they've ever had in their homes. Okay, so there could be something years down the line that comes along and kills this whole rally. We don't think it's going to be housing. We don't think it's going to be debt. Okay, and this is why when you focus on the data and you tune out the noise, you will see that the average consumer, and remember, we are a consumer-driven economy. 71% of our economic growth comes from consumption of goods and services. So if you get a pulse on the consumer, you get a pulse on the economy. So that's what we see here. So tune out the doomsdayers that are telling you that debts are all-time highs. What they do is they play this funny little trick and they report debt in aggregate dollar amounts, not relative to assets, right? So that's like saying, hey, global debt was 9 trillion, in 2008 and it's 20 trillion now, right? And people they don't give you the context and you go, wow, 20 trillion, that's a lot more than 9 trillion. Look at the asset growth that goes along with it, right? Balance sheets are in better shape. So I always use the comparison of Apple, right, as a stock. Apple has way more debt today than they did 20 years ago, but their assets have grown 20-fold, right? And so the debt to asset ratio is much healthier today than it was back then, and the same is true for American households. Another thing to watch, and this is naturally always affects the markets. Trump is getting close to nominating his next Fed chair. Jay Powell has 4 months left on the job. Trump is likely going to announce the successor in the next couple weeks. And the shifting, this is just Polymarket that tracks the different candidates for Fed chair and the probabilities and odds of them being picked. And we have seen a major shift in these numbers over the last month. Originally, and for the last 4 or 5 months, Kevin Hassett, the chair of the Economic Council, was the front runner. Until about a week and a half ago, when Trump was giving a speech and he said he likes Kevin Hassett so much as economic chair, he doesn't want to lose him to the Fed. And then his odds plummeted, right? And he was out. And then Kevin Warsh shot to the top of the list as the next likely Fed chair. And I'm going to tell you that the markets didn't like that. They didn't like it one bit. Now, why is that? Kevin Warsh, I'm sure he's not a bad guy, but he's somebody that's been at the Fed for 20 plus years. He's a Fed insider, and the markets are really yearning for an outsider to come in. Okay? So, enter Rick Rieder. Rick Rieder is the chief investment officer for BlackRock, okay? The largest asset manager in the world. Rick Rieder is also known as a bond king. And that is a very good thing for the markets because when you're running the Fed, you need a very good understanding of the bond market. And there are very few people walking this planet that have a better understanding of the bond market than Rick Rieder. So Rick Rieder satisfies the market in a couple ways. He's ultra smart, he's Wall Street friendly, he's affiliated with BlackRock, so you know that he's been uber successful, right? He's Larry Fink's number 2. And he's an outsider, and he understands the way monetary policy plays in to all these different things. He's got experience in private equity, he's got experience in bonds, he's got experience in real estate. So he's a really well-rounded pick. And recently, you can see here, he has shot to the top. He's a 44% likely pick. That number just 2 weeks ago was 11%. Okay, so obviously as Trump makes public comments and you hear these different things, these odds can shift again. Warsh could shoot back up to the top. We know it's not going to be Scott Bessent down here at 2%. He doesn't want the job. He wants to stay at Treasury. And Hassett's pretty much out of the picture. Christopher Waller, another Fed, a long-term Fed member, very unlikely it's going to be him unless one of these top 2 guys pulls their name out of consideration. So again, nothing strategically that we're going to do around this, but as these odds shift in different directions, the market's reacting to that. So let's take a look. What do we have coming up next week? We have some delayed reports of undurable goods. That's from when the government was closed, so I think we're going to discount that. It's already about 2.5 months old. Consumer confidence on Tuesday, that's always a good report to watch. How do consumers feel, right? We just talked about how the consumer-driven economy is very important. So let's get an idea what consumers feel. The last reading came in at 89.1. They're looking for a slight uptick to 90 for the economist forecast. So let's take a look at that. Wednesday, January 28th, the FOMC interest rate decision and the Fed Chair Powell press conference. I don't know about you guys, but I'm pretty tired of listening to this guy and his press conferences. You can go back 60 years and look at Fed chair history. This guy, when he talks behind a microphone, markets just seem to go down. Okay, he's like the only one that was like that. Janet Yellen, the markets loved her. Ben Bernanke, the markets loved him. For whatever reason, markets don't really like when Powell speaks. I think it's the uncertain tone that he speaks in, but a few more months, we won't have to deal with that anymore. But what is the Fed expected to do? The Fed is not expected to do anything on Wednesday. So there is a 95.6% chance the Fed leaves rates unchanged, right? And this has been expected now for a month and a half since the last meeting when they cut rates. There's only a 4.4% chance that they cut interest rates, right? So when they announce no cut on Wednesday, don't be surprised. The markets won't be surprised. It'll be his press conference after and what he says about the next meeting that's going to be important. When we look right now, so this is the January meeting. There is no meeting in February. The next meeting is in March. And you can see for March, they think there's an 84% chance that they keep rates the same and a 14% chance that they cut. So in a hypothetical scenario, if Powell comes out this Wednesday and hints that March's meeting is also going to be no cut, it shouldn't be a great surprise to the market. If he gets dovish and says we may be cutting in March, probably not likely he'll say that explicitly, but if there's hints there, this 14% is going to shoot up and the markets will probably rally on that news. But again, let's take it one meeting at a time. 95% chance he does nothing. I don't expect him to do anything. If they did cut, it would be a big surprise to the markets, and markets really don't like markets like that type of surprise where rates go down. They don't like surprises on the other end where rates are, perceivably staying the same or going higher. So we have that on Wednesday. That's the interest rate decision. Thursday, we will get some information on U.S. productivity, jobless claims, and the trade deficit, but those two reports are delayed from the shutdown, so there's not a lot of weight carrying there. And then on Friday, we're going to get some inflationary data, the producer price index, which will tell us about the wholesale side of inflation and how things look on that front. And then the week after that, we'll get to that when we get to that. Okay, so how do investors feel? Retail investors feeling kind of neutral, right? We're sitting pretty close to all-time highs on the S&P 500. We were neutral a week ago. We're neutral now. Very natural to see this type of uncertainty around a volatile week in the markets, which is what we had this week, even though it was a 4-day trading week. So, all in all, just to summarize back here for a moment, we're starting to exit the fake out zone. We're going to look for earnings to come in strong to start to propel this market higher. And we're going to look for commodities just to cool off a little bit, to stop hogging the limelight from stocks and stop hogging all the capital flows, right? Because most investors are a day late and a dollar short. And instead of buying gold a month ago, 3 months ago, or a year ago, they will rush in and frantically buy this at the top, right? Rinse and repeat. Human nature never changes. So, all in all, markets are shaping up very nicely here. I think soon enough, a lot of the malaise that we've seen over the last few months of this sideways choppy action will be laid to waste, and I think that the markets will be on their way to our mid-year target. So, if you have any questions, of course, reach out to us. We're always here to talk to you about anything that matters with your money. We hope you have a great day and a great weekend, and we'll see you back next week for Heritage Insider Weekly.